The most important element to get right when investing is properly determining what the market trend is. In fact, if you get that wrong, it doesn't really matter what company you're looking at, doesn't matter the fundamentals, doesn't matter the corporate outlook. If the market is down and you're trying to buy, you're likely to be losing money, and vice versa. And interestingly, in an up market, a really strong market, bad news tends to get ignored. Similarly, in a down market, great news can come out by a company and it's sold into. So figuring out market trend is critical. Now, the way most people will identify a bear market is an after the fact analysis. So people will say that if the market has fallen by 20% or more, it's a bear market. If we fall in 10% or more, it's a correction. And those are good numbers. It's a good framework for being able to look back historically and determine together with it, an even definition, what was a bear market, what was a correction, and how to identify them. But in real time, we need to figure out as it's taking place. I mean, it's not really much help after the market falls 20% to figure out that you're in a bear market. So how do we go about doing this? And we want to do it in an objective way, and we want something that will work in all market conditions. So not something that just was a good technical indicator one time or caught one top. How do we really identify the key driver of the market? Now, there's one tool I found that I think is incredible, and it really changed the way I look at a lot of things in the market, and we'll get to that in a moment. But if you sit back, most people will claim it's company earnings. So most people will say that maybe it's the Federal Reserve's, their actions, whether they're raising or cutting interest rates. The reality is how it all really kind of comes together. It's the amalgamation of everything from investor sentiment to the multiples people are willing to pay that will ultimately determine what the market is going to be priced at or what it's going to be doing. So how do we figure that out? What's that driving force? How do we calculate that? And it's got to be done in a way that's simple enough that we can do it in our everyday lives. So interestingly, the Federal Reserve put out an indicator, the Chicago Fed, called the National Financial Conditions Index. This indicator that they built going back to 1970 tracks what is liquidity, what are financial conditions in the US economy. Now, essentially, this is comprised of over 100 indicators. It's a very robust and broad indicator. It's not just one measurement that they're looking at. There's actually over 100 different measurements in this indicator. And this is very helpful because it captures the financial conditions, which is most people will call liquidity. And it's really liquidity that drives markets because that impacts the credit cycle, that impacts the ability of investors to borrow and be on margin invest in the market. It allows people to kind of reinvest in new plant and equipment. That is the driving force. It's the lifeblood of the market. And don't take my word for it. Let's take a look at this chart here where we look in the bottom panel, we'll see the NFCI, the National Financial Conditions Index. In the upper panel, we'll look at the S&P 500. And you'll notice that whenever the NFCI is climbing, you'll see the line is red because that means financial conditions are getting worse. They're getting tighter. It's getting more difficult to get liquidity in the market. And whenever the line is declining, you'll notice that it's green, and that means that financial conditions are becoming easier. It's easier to borrow. It's easier to access capital. And you'll notice that every important trend in the market is driven by, or at least it's identified by the NFCI. I mean, the S&P 500, whether it's climbing, it typically takes place with the NFCI declining. And when the S&P 500 is falling, it's usually because financial conditions are getting tighter and the NFCI is climbing. Now, it's really important to look at this because many people, again, will look at interest rates as the right measure. They'll look at what the Federal Reserve is doing. They'll look at the 10-year yield because they figure, hey, if bond yields are falling, it's easier to borrow money, it's going to be easier to invest in the market, and that should push up stock prices. But again, we want tools that will work in all market conditions. So if we go back, and let's take a look at the 2008 financial crisis. You'll see here in the top, we have the S&P 500. Underneath that, we have the federal funds rate. That's what the Federal Reserve sets interest rates for basically overnight borrowing. It's the core interest rate of the market, and this is what you always hear about the Federal Reserve adjusting. Then there is the 10-year yield, so the interest rate on the 10-year bond. And at the bottom, there's the NFCI. You'll notice as the market went into the financial crisis and had one of the worst bear markets in history, the Federal Reserve was cutting interest rates. The 10-year yield was falling on bonds. So someone just looking at interest rates would have been trying to say, hey, we should have a bottom. We're getting the Fed's helping. The Fed is cutting rates. And the market just collapsed during that time. However, if you look at the NFCI, which is a broader measure that looks beyond just what the Fed is doing, because the Fed is just one component, you'll see that it was showing that financial conditions were getting tighter. They were getting more difficult in the environment, in the market. And that was a much better indicator to say this is a risk-off environment. I should be on the sidelines. And it's not only 2008. Let's look at the recent COVID crash in 2020. Again, look at interest rates, how they were falling. So anyone just looking at interest rates say like, hey, we should be buying stocks. And the market obviously fell very quickly because of the COVID pandemic. But the NFCI did the right job of identifying that no, even though rates are falling, general financial conditions are still getting worse. So how does the NFCI do this? What is it built of, and what makes it so special that it can pivot? One day it can kind of show what interest rates are doing, other days it shows different things. Well, unlike interest rates, which are just one snapshot of the economy and of liquidity and the ability to borrow, the NFCI is made up of three components. There's credit, so interest rates. It does have a big component of that in there. There is leverage, so how leveraged the system is, and that gives the ability for people to be able to withstand shocks. And the last one important is risk. Risk is very important because, and I think that especially going back to that 2008 example, it didn't matter that interest rates were falling. The risk in the system was spiking. The financial system was freezing up. Lending wasn't happening between banks, banks and consumers, because even though rates were falling, people were so uneasy, so concerned about the general economy that risk was rising, and that was the more important weight in the NFCI versus just interest rates. If you like all of these tools, by the way, we recently put out a white paper where we talk about all of this and break it down in a little more detail, which you can get at my website, Caruso Insights. But of course, there's a link in the description below, and all of the indicators we use here and some others are all available for free in TradingView. The links are in the white paper as well. Now, that is the general market, but I know it's easy to kind of then take it to the next logical step and say, but if my company is growing tremendously, or if they're doing, if it's a good company, like a lot of people will say, does it really matter if financial conditions are tightening or loosening? And what kind of an impact does that really have week to week or month to month? Is this just a bear market or bull market type of situation? Well, it actually has a dramatic impact. Let's take a look at what has been the recent darling, which is NVIDIA, which has, changed the world around us in terms of technology, enabled the companies like ChatGPT and all this AI revolution, and the stock price had a massive advance. But if we look at the price of NVIDIA with the National Financial Conditions Index underneath it over the past few years, you'll see everything from that 2022 bear market to the 2023-24 bull market, even the pauses in between, even the normal kind of basing periods of NFCI, even the normal basing periods of NVIDIA all took place with the similar movements being reflected. So this really goes back to a really famous quote by Stanley Druckenmiller, you can see here up on the screen, where he basically says what drives stock prices are not fundamentals. It's liquidity. It's what the Federal Reserve is doing. It's interest rates. It's everything we were talking about. That's really what drives the stock prices. Because again, the company and the stock are two different things. Ultimately, long term, that will match up. But over the course of several months or a year or two, it is more linked to liquidity and changes in liquidity than the fundamentals of the company itself. It's really both together you have to look at. You can't ignore one. And of the two, liquidity is the most important. It has the most direct influence on stock prices. Now, there's one issue with the NFCI. It's comprised of over 100 indicators, but the issue is that of those 100, some are only updated, many are updated weekly, some are only updated monthly, some are only updated quarterly. So a quarter can be a lifetime in the market. And you can see the indicator does move, but when those quarterly revisions come in, they'll go back and it'll back adjust the NFCI, which in real time can cause some tracking issues. So we've gone beyond just the NFCI, and we've started to follow other tools that move along with the NFCI, that reflect its moves, but that are real time in the market. And we're going to be going into a complete deep dive on the market, all the indicators that will determine market direction, what's the right exposure levels to have in the market based on liquidity, what are signs that there may be a market bottom developing or a market top at the extremes. And we're going to be covering all that and a lot more in an upcoming workshop, April 12th, where it's an entire day dedicated to market direction, understanding how to put it in a easy to use objective system that's driven by the actual core variables that drive the market. You can find out more on my website, carusoinsights.com. But even beyond that workshop, just having this core understanding of what drives markets is so important. And we'll go into the other components in future videos, but I want to at least bring this idea up so people can kind of look at the market with the right angle, with the right perspective, that it's all of these components that drive stocks. It's not just interest rates, it's not just fundamentals, it's liquidity. And the NFCI is just a great way to track that. So if you enjoyed this video, please subscribe. You can follow me on Twitter at Caruso Insights. And of course, my website's carusoinsights.com.